Good evening, everybody. Thank you for joining Terra Equity on this Thursday evening as we discuss investing strategies, combating inflation in a recessionary timeframe or phase rather. Give everybody another minute to jump on and then we'll get kickstart this webinar. So just another minute. We are recording it. So those of you who will miss it, you can certainly watch the replay that we'll send out. So just as we're waiting, I'll kind of highlight how we're going to go through this. We'll talk a little bit about Terra Equity Group and our principles and what we follow and what our acquisition strategy looks like, a recent wins. We'll talk about the current market conditions, and then we'll go into one of the projects that we have available in the market right now. So we'll talk about that. So kind of segue into that and then take any questions, do a Q&A session as we get to the end of the webinar. So the time is 7:01. We'll kick start it. Once again, thank you on behalf of Terra Equity for joining us tonight as we discuss inflation in a recessionary time. So. All right, so here we have the disclaimer. Please, this is for educational purposes only, and the results here are only past results. They do not indicate any future performances. And who we are. So at Terra Equity Group, we are a family-owned and operated business where we focus on a few principles as our guiding light. We value relationships. We invest in emerging markets, which helps us get the returns and the results that we have historically. And as a result of curating those relationships, Vino, our founder and CEO, has been in the real estate space for over 25 years. A lot of the deals that we get into are off-market deals, which enables us to do value add on those projects. And certainly the returns are very well on the end when we exit. And a hallmark guiding light that we use here is capital preservation, as Vino always likes to quote Warren Buffett, who's a firm believer in capital preservation. His rule number one is don't lose your money or don't lose your capital. And rule number two is go back and see rule number one. So with that in mind, that's what we have focused on here at Terra Equity Group. And that has certainly been a driving force behind our success in the past decade or even longer than that. Our values, once again, family, passion, and legacy. We value the relationships. We create the communities we create, and those relationships can be either the tenants or the investors that we work with, our partners, our lenders. So we really believe in long-term relationships and really curating them and being there for our partners that have helped us, and certainly that help us going into this as we go through these times. And certainly those relationships do come to fruition as we get into some of these deals. And as we talk about this particular deal that we have here in Orlando, we'll highlight some of the, big reasons those relationships came into play and how we got the deal on our side. So a little bit about Terra Equity Group. Again, Vino is the founder and CEO. Here are our partners, Stephanie's here, and as well as I am. 20 years of syndication, commercial real estate experience, over 25 years of real estate experience, and certainly manage close to 4,500 units right now in the southeastern United States with assets around $350 million. Recent wins. These are some of the recent projects that we have taken over. And as you can see, the projected returns are averaging around the 25% mark on an annual basis. Switch here as well. We see the same trends. These are some of the other assets that we picked up earlier in the 2019, 2018 timeframe. And these have been our most recent wins dating back to last year and early this year. And with the Silver Star portfolio being the most current project that we're working on right now. All right, so now I'm going to turn it over to Karan, who's going to talk about the current market trends and what we see here.
Hi, everyone. Thank you for joining us today. Just want to give you a little bit of insight on, where we see things and how we can, combat and move on from those. So right now, what we're seeing is that inflation is much higher than previous years. We are starting to see some stabilization in the last couple of months. Obviously, no one's really sure if that's going to sustain, but that's something that's kind of what we're seeing out in the marketplace. If we can go to the next slide, please. And then also we saw for the second consecutive quarter, we've had negative GDP. We are technically in a recession. So how we go about combating that recession, how does multifamily investments fare in that? We're going to touch a little bit of base onto that as well. So onto the next slide. So one thing that's a little bit of concern that we've had investors bring up to us is that, hey, interest rates have been increasing steadily. How do you combat those interest rates? Now we're seeing that they have been going up. We did see a peak in early June and a little bit of a correction since. But as we go through all of this process, we're going to really touch base on how interest rates, things like that, are affected. The benefit of multifamily investments that we see is as interest rates go up, so do the cap rates at which you're able to purchase properties. So there's an offset over there where you're able to generate a little bit more on the cash flow side. But on to the next one. Now, interest rates going up, going to that 5-6% rate, I know that's a big concern, but we have to remember that for multifamily and commercial spaces, the interest rates are based off the 10-year treasury rate, and the 10-year treasury rate is substantially lower. It's also had a peak in June. It's leveled off a little bit since then, but just as is the balance over there, as the interest rates go up, cap rates also go up, and then really the basis on multifamily investments is more towards the actual cash flow and things like that. So now we're going to get into the actual specifics. So I'm sure, if you've been keeping up, you've been hearing how much the rents have changed year over year. A lot of this is due to there's very few apartments being built. There's been a huge supply chain shortage. I'm sure you guys have all experienced how when you're trying to go purchase something, sometimes there's a huge back order for it. So that's affecting all aspects of the multifamily space as well. There's just not enough new construction being built out there just because no one has access to that level of supply. So that's really what's causing the primary push in rental increases. And interest rates aren't really affecting the rental charge as well. You can see year over year, markets like Orlando, Miami, Fort Lauderdale have seen over 10% rent growth over the past year in the month of August alone. And, more individuals are going to be unable to purchase the homes as well as a result of this increased interest rate, especially on single family residences and other, estate homes, things like that. So that's really causing a push towards people entering into the apartment cycle or the renting cycle. And as you can see, within Florida especially, there's close to around 5 of the top 20 markets are in Florida. And the average time where a unit stays vacant is pretty short term. So if we can go to the next slide. And then specifically, we're still waiting September numbers, but even in August, we're seeing that trend is still holding strong in terms of the rental growth that's there. The main cause is just that there's not enough supply out there to sustain the demand. So if we can go to the next slide. So let's briefly get into why multifamily investments are, kind of one of the better investments they can get into. There's 4 real core reasons. The first is that several people are looking to rent, and it's not just millennials, whereas in the past, it's people looking to save up for homes. Right now, there's a combination of people renting to save for homes, as well as they're unable to actually, go out and purchase with the interest rates being so high. So people want to hold off on that home purchase. They prefer to rent. The second is that there's a lot of investment, and there's a lot of migration happening into Florida, into other really in-demand regions. People are leaving the states where home prices are getting priced out of states like New York, California. Additionally, with the one thing that the pandemic has caused is that there's a lot of now remote work opportunities happening, and people are starting to transition to places where they feel the most comfortable, whether that be with family. And then, additionally, there's just a wide variety of different multifamily things. So traditionally, this is kind of what the multifamily cycle looks like. We're looking at, there's a buyer's market slows down, go into a seller's market. That's there's two real stages of that. So traditionally, we would be what we call in a seller's market too, where there's declining vacancy rates. Rent increases are driven by renovations, constructions. There's a decline in unemployment. But now, if you go to the next slide, please. So this is now what we would consider the multifamily cycle to really look like. As the rental increases, and again, as a caveat, this is only specific to certain markets that are really being generated and pushed to as a result of really high demand for renters. So, this is kind of where we see things, and we're actually probably more closer to the buyer side right now, as the rent growth is not as necessarily as strong as it was a month ago. It's still way more than what it was a year ago. So that's kind of how we're viewing the market. And now I'm going to hand it over to Viraj, and he's going to jump in to a little bit about the Orlando opportunity.
All right, everybody. So the investment opportunity we're here to talk about today is our recently closed property of our Silver Star portfolio, which consists of two beautiful properties, Highgate, which is 320 units built in 1990, and Collington, which is 216 units built in 1992. It should be noted that the construction is absolutely top quality. It's a concrete block construction, and we prefer this type of construction here because, Florida is more prone to hurricanes. We just had Hurricane Ian that passed by, and it's largely resistant to mold. Now, as you can see on this slide, you have the purchase price of $109,300,000 by investors. The investors share 65% of the ownership. The total capital raise is $13 million. And the minimum investment is $100,000. Estimated holding time, what we've done previously and what we're used to, is 3 to 5 years. And the park at Highgate and Collington is a property that's in a very desirable location. It has very close proximity to the theme parks and lots of office and retail space, even a lot of schools. The opportunity here is to significantly boost the value by rehabbing majority of the units. Next slide, please. So as you can see here, this is kind of the breakdown of Highgate and Collington. You have, Highgate, which has 320 units, and Collington, which has 216 units. For the property that we're currently managing there, we have our own property management team in place. So the reason we liked Orlando in this area, because we can have all of our contractors, people that we know there, people that are on our team, to just take over and run this in a very efficient manner and bring these property units up to scale really, really quickly, without wasting time. Next slide, please. So as you see here, this is our phase of what we're doing, our game plan on, you can call it, of what we want to do with Silver Star. So phase one, we want to increase the rents to market. The opportunity here is to increase rents to market level because currently they're under by more than $100 per unit. Per month per unit. Incorporating proven management will enhance tenant retention, decrease expenses, and provide superior service. So for phase two, we want to focus on leasing opportunities. We'll involve leasing out the units by either offering renewals to our good standing tenants or looking for newer ones and weeding out some of the bad tenants that may have been behind on their payments or people who are going to be evicted. Leasing out efforts will include rebranding, including large signage and advanced marketing, signage. Emphasis will be on bringing quality tenants in order to limit turnover and allow for steady rental increases. So we really want to bring in people that are very familiar with the area, that either work in the area, because there's, a lot of growth happening in Orlando. So that's going to be a really big opportunity for us in phase 2. As far as phase 3 is concerned, this will just include, fixing up the exterior, whether that be paint, fencing, renovating the laundry room, and obviously the new signage, like we mentioned before. We're going to upgrade the units. So we want new flooring, kitchen, bathroom, all to be brought up to speed of what's a more modern look. And definitely a more attractive exterior, interior enhancements will attract the higher quality tenants, as mentioned before, and will help facilitate the leasing efforts and will justify the increase in rents. I'm going to pass this on to Mr. Vino, and he will go over the financial summary.
Good evening, everybody. Here we're showing a projections for our properties for next 5 years. And the first year is starting out that, we have all our, rental growth, steady growth, year 1, year 2, year 3, year 4, we're expecting 5%. Even though Orlando, we recently have increased August and September, we got a, unit done rehab. So we are doing almost 38 and 39% rental increase on the renovated unit, and close to 35% as is unit, just make them ready. So the growth is tremendous in Orlando. Orlando, fears like number 1 in Florida. As we learned from Orlando and the counties, there are 20,000 unit shortage in Orlando. So a lot of movement, a lot of people moving to Orlando, and the growth is tremendous for next couple of years. We are very conservative when we are marketing, or projecting 5%. We are already achieving 38% on year 1. So our projections are going to be blown away out of the park. This one is like we projected 9% cash on cash return, 11, 12, and 14. But if the trend keep going, and that's what been projected for next year, they're always going to be in double digit. But we underwrite our deals is very conservative. So we have projected on projections 5% increase. Expenses may be lower when we were projecting, so that could go a little higher. But the rental growth is tremendous in Orlando. And this financial analysis form that you see, we have majority of 2-bedroom, and then 1-bedroom and 3-bedroom. We will project. Previous slide, please. We were the rental increase one. So in this case, like you can see at the Collington, you see 2 bedrooms. Rent per month was $1,200. Market rent was almost, $150 more than we achieving far more as is on Collington. 3-bedroom, I'd like to give you example. We were projecting $1,600 after the rehab. Right now we are collecting $2,100, or we pre-leasing 3.2 and $2,100. So you can see how we underwrite. We are very conservative when we underwriting, and our projected returns is going to be way high. Now you can go to the next slide. So here we are projecting annualized return based on over very considered projections like 23%, 23 plus, but we should be achieving way above 23% annualized return. If somebody invested $100,000, they expect to achieve that $65,000 to that, and then when we sell it, another 23%. So total overall, our projections are very, very close to 25% annualized basis. Again, we have given example that when we sell it, in 3 to 5 years, cap rates are when we bought it and what we're projecting. We, projecting in the middle of so we're assuming we will sell it at 4.75, even though as of now, the properties are trending 4 cap, 4.5 cap, but our revenue is going to increase so high. So even if we're selling at a 4.75 or higher cap rate, we will have very decent profit that we're projecting.
So now we'll get into how do I qualify. Certainly, this is an offering for accredited investors. There are some of the FAQs here also answered. So, which are some of the common questions we get a lot of the times from investors that are new. Typically, our seasoned investors already know a lot of this stuff and how we operate. There are two tier levels of investing here. At the 100K level, you're getting a 7% preferred return, as Vino had alluded earlier. And at 250K and higher, you're getting an 8% preferred return. Just like to reiterate the fact that in the financial analysis that Vino spoke of, we underwrote the deal at 5% rent increases. Currently, we're getting 36%. Even Karan had highlighted that Orlando is seeing about 32% rent bumps. So we're even above the average that we're seeing in Orlando. And that certainly speaks volume on the project itself, the location, the value add proposition that it provides. So it certainly checks off all the boxes that we have on our end in terms of an astute investment that is going to go splendidly well as we exit and as we head. A lot of people have the questions, well, this type of growth, is it going to continue? And we certainly feel that, yes, it may continue for another, year or maybe 6 months. We don't know. We don't have a crystal ball. However, what we need to note at the moment is that we are capturing year 3 pro forma numbers right now in the first 3 months of ownership. So even if that growth slows down or even if it plateaus in due time, we will certainly be able to have hit those pro forma numbers already, and whatever incremental increases that we'll get throughout the remaining of the hold period, it's certainly going to be the icing on the cake. Right now, there is a housing crisis in Florida. We have certainly close to 2,000 to 3,000 individuals moving in on a daily basis. A lot of them do move to Orlando since it is in the middle of the state, and certainly as they get their bearings and they really want to or get to know where they want to live or end up with, they have that transitionary phase that we see that they spend and they end up renting. What the point to be noted is Disney currently is building 1,300 units for its employees because they are having a hard time finding housing. Same thing that Universal Studios is doing. They're building 700 units for their employees. And that's a good testament as to where the market is headed. Certainly, as Karan mentioned, the supply chain issues are, and the cost of construction going up is driving a lot of the individuals who would have traditionally bought a home to end up renting, right? And we're on the receiving end of that rather, and we're primed for growth and success as these properties are well situated. Vino, is there any other thing that you may want to mention regarding what we're seeing? And I'll kind of, update everybody on, the hurricane and that impact, which is minor at these properties, but just still want to, bring that up.
Well, another thing is like Orlando is really suffering and they need more unit come online, and the construction is not as much as they're predicting and they should have been, even though there's a few buildings are coming online. And second thing is the hurricane has caused a lot of, house damages. Those people are also going to be looking for the rental property. And also, even the interest rate going up caused a lot of people, they can't afford to buy anymore. So they will be still, looking to apartment side of it, and that's the, growth we're projecting. A lot of businesses are moving there. A lot of people from California or New York moving to Orlando in that area. So those are the, main thing that we see in our growth.
And as I mentioned earlier, this again was an off-market deal that came through to Vino through a broker relationship that was curated over many years. Certainly, we picked up the property here at about $169,000 a door. Our all-in cost would create the acquisition at about $200,000 a door, which includes 10 million rehab budget, extensive rehab budget that includes interiors and exteriors. And still we have about a $50,000 delta because the comps in that market for even older vintage properties in the similar area is at about $250,000 a door. So we already have built-in equity going into the project. Our cost basis is phenomenal. We're already in the green. You know, you want to touch upon that in terms of what type of appraisal we have obtained and what have you, and based on what we actually paid per door, which was, 91 million, which is 169 a door. And we have a huge runway in terms
So
of.
the actual purchase price was, $91 million plus the rehab money and plus the closing cost. That's how we came up with the 109. But based on that, all in and updated units, we're going to be close to $200,000. The current market state is that properties, that has not been gone through the rehab process, they're still asking $250,000 per door. So, based on our appraisal that time when the appraisal guy did it, it was $130 million. They projected 130. We project much more higher than $130 million price at the end of the 3 years or 4 years time frame.
Okay, and certainly based on the trend of the rents that we're capturing on simple units, which are just being rehabbed and turned over, which are not being rehabbed, they're simply being turned over. We're seeing an average increase in uptick in 36% over in place rents. So that is only going to help enhance that value come the 3-year mark as we're exiting this project. Again, emerging market, and there were some questions and concerns. There's rumblings in the news regarding. I know at Florida we are landlord-friendly state. I know that's why we're heavily invested here. In Orlando, in this particular county, there were some reports out that they're trying to put rent control there. Can you have like 2 cents on there and kind of provide some clarity for a lot of the individuals on the webinar today that may have some questions?
Basically, it's not the rent control. I guess that, counties are trying to minimize that how many people and how much you will increase that, but in Florida, as long as you give the notice 60 days before you're renewing the lease, then you can, increase how much you want depending on, so if they want to find some other place, then they can go. So we have a 60 days buffer to and we've been doing it 90 days before, it's like almost 90 days, the lease comes due in 90 days. We ask them, this is going to be your new rent. And so we're giving plenty of time. Second thing is, I think even in the state of Florida, owners and Florida, I think the Brokers Association, they filed a lawsuit because it's illegal to, limit the, rent increase. So I think that's what I heard, but I don't think, we are affected by, what they're talking about.
Yeah, so I'll kind of piggyback on that one. This was the county commissioners who kind of put this on the ballot for this upcoming November elections. There have already been 2 lawsuits that have been filed against them that this is unconstitutional as per the Florida law. So with that being said, again, the biggest limitation is you have to provide ample notice, and that limit is at least 60 days. We're already ahead of the curve. We do 90 to about 120-day notices for individuals when their leases are coming due. And then furthermore, even if this gets passed, that's a big if, then it's only going to be valid for 1 year, and they're going to cap, they're talking about, again, 10%. In line with what the inflation has been over the past year. So certainly not a cause of concern for us as we head into this. So great clarity on that one, Vino. I know there was a few months ago, Disney was hit with a big tax bill because they got that special class that they had, or that district kind of stripped away from them. And I know a lot of individuals had concerns as to what happens if Disney moves. Clearly, if they're building 1,300 units right now, I don't think they're going to move anytime soon. Certainly, it would cost them more money to relocate. In today's day and age, for them, that $200 million tax bill is actually, a drop in the bucket, because they just have to upcharge a little bit on their ticket pricing, and they'll recuperate that in no time. So certainly that is not a concern. I know there was a lot of news and what have you about it a few months prior. Vino, anything else you can think of what's happening? Do you want to touch upon the impact that the hurricane had on the properties and dive in? I know you were there this past week.
Well, we have a very minor effect, other than one office building, one big tree, even though we were ahead of the game and we have trimmed all the trees and there's a lot of trees on these two properties. So we got all of them done, but somehow we missed, we didn't miss, but it was a healthy tree that fall on the office building on the corner. So that's the, big damage. The smaller damage, some tile flew here and there. We're still going through, but not a major damage to the buildings.
Okay, so that's a good, good point on that. What else? I'm trying to think. Let me see what else. In terms of where we're headed, the growth, the market, the impact on the hurricane. As we exit, I know have been questions in the past. What's our exit strategy looking like? A lot of people are concerned that if these interest rates keep going up, how does that impact our exit strategy? And not only in this particular project, but in general, we're coming due on some of the exits on some of the other projects. So how do we get stacked against that? That's a little bit of a concern. And then if you want to talk about the impact of interest rate, I know there's some bridge loans that we have on some of these assets. And I think there was a few things that we did being very proactive, or rather you did, and kind of looking what was on the horizon. So can you touch upon those two things as we segue towards the end of this call and maybe get ready to open up the Q&A?
Well, the interest rate, we always, when we buy a bridge or we get a bridge loan, we do the rate cap, and we have on this property, it will never go more than 3.5% for us on this large portfolio. And we were lucky enough to get it as a 2.1% interest from the Key Bank as their balanced portfolio based on the relationship. So, our exposure is up to 3.5%. That's it.
Okay, so we purchased, and not just dating to this particular project. I know there was projects we closed in the beginning of the year, and you were very savvy enough to look as to what was happening and the rumblings that you heard out of the Fed Reserve and what have you. We were very proactive, even in those projects that we closed in the beginning of the year, to pick up these interest caps. Or rate cap rather, and now we're certainly, as these interest rates keep climbing on a monthly basis, we certainly see the benefit of that. And at that point, it seemed, a lot of individuals probably may have questioned. I know as we're closing, I remember some of those conversations with the brokers and what have you were, saying, hey, why are you purchasing that much? But certainly in hindsight right now, that was one of a great actions that we took to be very proactive and certainly not have that much of an impact on our cash flow as it would have had we not purchased that. So great point on that. I know you mentioned about the exit in terms of the interest rate. There was one other thing I had in my mind and I think I completely slipped, but I'll have it as it comes. I'll chime in. So we did the interest rate, the hurricane, inflation. I mean, what other current trends do you see right now as I know we're heading into the election cycle in a few, short weeks. We're going to be in midterms. Are you seeing, what do you foresee as that kind of comes to fruition, and those, the results of those obviously elections are going to be telling as well as to the state of the economy and how that impacts it. But
and the interest rate is here to stay for the next couple of years. They're not going to drop it as soon as, but what we're doing with the properties and how we're doing it and how we're selling it, what type of financing we're bringing in, those are the important portion is going to be. Because, maybe everybody is not equipped to get a financing, like even though the finances are going up and we're looking at another property, but we have a pension funds, we have, insurance companies, they finance, and they like these large deals, and we can always get a better rate than anybody else out there through Fannie Mae or anything. So, like you mentioned early on, for 25 years of experience dealing with different people and creating the relationship, that's what we're doing. Now, what I see in apartment industry, there's a lot of people who missed and they still have the bridge loans. They're going to be having some problems. So we're looking to pick up some more deals. Not, when somebody's losing the deals, but we know there's a market out there. Sellers are getting educated now that say, hey, you got to drop your prices. We already seeing 15 to 20% dropped on their initial pricing, what they were doing. So, these are some coming up trends that you can able to buy good properties, and as long as you have relationship, you can get a good interest rate.
Great. And I'm going to touch upon that exit piece, Vino, that you mentioned. I think there's one thing that is worth notable, that this is a 2-property portfolio. So we can certainly section off and sell it as, one particular, property at a time if the need be, if the push comes to shove. Certainly, this is not your first rodeo as well. I know you had gone through this in the 2008 and 2009 downturn. You certainly came unscathed out of that, and you had a lot of learnings out of that particular time frame. And one of those I remember was certainly about the B assets, and that's why we're so laser focused on those B assets, because in times like these, those B assets are super resilient in terms of providing great cash flow, and certainly not succumb to the economic environment that we may be going through and the turbulence that we're seeing as we navigate through these rough waters, right? So with that being said, I know you've been through the dot-com boom and bust. With COVID now certainly kickstarting this whole downturn, it's worth noting that we did phenomenally well. We had a great collection rate, 94%. Throughout our portfolio. We continue to distribute to our investors on a monthly basis. We did not pause even for a month. And that's a great testament and a good litmus test for our business model and our acquisition strategy. Anything you want to add on to that? I may have hit a lot of that, but you may have some nuggets that you want to,
Well, we are very, laser focused and, very conservative in our underwriting. So when we underwrite, we, look up these kind of situation, what comes, what if this, so that's why when you see our underwriting with only 5% increase, can that be sustainable? Yes. Can we, beat our projection with only 5% for next 5 years? Yes, but we are already doing it. I think we're going to overperform. So, looking at the market condition, looking at interest rate, they're always up, always down. Sometimes are better, sometimes are. So as long as you're focused what we are doing and how we manage our expenses and how we increase our rent and how we manage our interest rate, those are the 3 big factors.
Very well said. Very well said. At this moment, I think I'll open up the floor as we're getting to 30-minute mark. I want to open up the floor if any of the attendees have any questions. I know some of you had some questions off to the side that we have answered, but any other questions that we can certainly answer for the attendees right now live, would love to do it and kind of get your take on what we have presented and if anything that needs clarification. So while we wait on that, I know you mentioned, Vino, you mentioned regarding the interest rate that we got as a question pops in, but that interest rate is completely unheard of in this market time. And I know when we put the property in contract, it was, earlier in the beginning of the year. And certainly when we got financing on it, it was through as the market was changing. And even then we were able to secure that type of rate. Can you speak a little bit on that? I know you hinted upon it earlier, but how did that come to fruition? And, what was that like working with the senior lender on that one?
Well, that was, based on the relationship, and it was working awesome. I mean, as a matter of fact, we got so low interest rate with them. So initially, a couple of months we have enjoyed, and now with the cap at 3.5%. I don't know if I understood your question right. I mean, you had like multiple questions in one question. So
No, but it's just basically alluding to the fact that you've been in the industry for so long, you've been able to curate these relationships, and those relationships come to fruition in times like this because they know your track record, they know you've been able to maneuver these type of times, and hence we're able to get those type of competitive rates, right? I also understand a portion of that loan is a recourse loan as well. That really tells our investors that we're in it with them. A lot of these syndicators that are going to be out there in today's time and day and age, they're doing this even just for fees, and they just collect their fees and move on. And who's really navigating the ship or steering the ship, right? Who's at the wheel right now? And they can't answer that for you. But as you pointed out, your 25% of the $70 million loan is a recourse loan. We're on the hook for that, right? We're also in the trenches in terms of the equity that we're pouring into this project as well. You know, within that 13.3 million, we have put in our own equity at about 20%, close to 2.6 million. So these are all hallmarks of an astute syndicator who will go in and you know, really goes to show you that we're in the trenches with you. Our best interest is in performing and having this see this project through and through, right? So anything you want to add? And then we have a question I would like you to answer from one of the attendees.
Yeah, I mean, let me answer the question first. Kathy, a question comes from Kathy. Kathy, our plan is still, you know, meet our projections. What we were talking about, the sellers who have not gotten the grip and they're still asking lower cap rate and high price. So we would wanted to, you know, make sure that what we have done, we bought it cheaper, or rental increase is there, and we are way ahead of our game to have that gain exactly to, you know, produce for our investors. So we are not hurt by, you know, the prices are coming down because we are not selling as today. We will be waiting on our net operating income based on the prices going to come along. Now, the other people, their net operating income is not there. They are not financeable. So that's why the price is coming down, and they have not upgraded those units. So we were talking about unupgraded unit, the wrong timing. Right now, the interest rate is 6%. Ours is 3.5%. So if that tells you that if we're increasing by 5%, or clearly last couple of months, and I think this year we can still be, you know, doing close to about 35% increase in our rental as the, you know, units comes online. So we should be, you know, I mean, I could assure you that this is under projections, what we're putting here in the slides. We will well above this projection.
And there was a question, Vino, regarding the waterfall and the hurdles. I know we answered this
Yeah,
already.
we just have a simple waterfall. We just don't want to make it a, you know, complicated, but our waterfall is 65-35 from the day one. So the investor, it's not like we did this and this is how much it's going to be. We make it very simple and easy for our investor to understand and for us to understand. So we're in a partnership for 3, 4, or 5 years. Majority of our project in the past, we have created double our investors' money in 4 years, 3.5 to 4 years. So that's our goal with this property also.
Very well said. I'll open the floor once again for any other questions. We'll give it another minute or two to see if, as I said that, we have a question here, or actually a comment. Okay. What else? We'll wait another minute or so, and we'll kind of wrap it up if there's not any other questions. I certainly can't think of anything that I want to add to this. How we're headed towards, or where we're headed towards in our economy currently. Nobody has a crystal ball. If somebody's telling you this, you know, I would steer away from them. Even as much experience as, you know, Vino's had in real estate, he can't pinpoint what's going to happen when, but you can see some factors in the market that have an indication of, okay, where the market may turn and things like that. And I know, Vino, you kind of called that out last year when, you know, there was a frenzy out there because there's pretty much free money and everybody was out there in the marketplace going crazy with these properties and selling. And it was a, you know, seller's market. And at that point, I know you made a comment to one of those brokers that, hey, you know, I don't think you've been in the game for quite some time and you haven't been through the last cycle, and the time turns, and surely a few short months after, we have a completely different marketplace right now with the high interest rates. And now you have a lot of those brokers kind of reaching out to you and even me, you know, for deals that are out there that, you know, and nobody's looking at right now because of interest rates. One more question. So we have an attendee asking, Vino, have you considered holding properties beyond the 3 to 5 year time frame to navigate tough times, or is the 3 to 5 year time frame definitive?
Well, Neil, time will tell us, but we always, for last 25 years, I mean, we have come out from the properties 3.5 years to 4 years, because our goal is to, double our investors' return within that time frame. I don't think it benefits anybody, especially investors, to keep holding and getting 8 or 7% preferred return, or maybe more, a little bit yearly basis. But they always like to come out from the project and go on another one where they can double their money again, 3.5 years. So if we can rotate in 1 quarter, in 10 years, 3 times, that would be most of the time our investors' interest is. But if the time comes, we will, update everybody that what we're going, but we think is achievable, even 3 years. Because, our goal is to, 2 times your money. We could do through the refinancing. We can get it, FHA financing. We can get it through the insurance, but, we would like to have our investor make their money and move on, unless they just say, okay, we want it to be on the long haul. So we always look up a couple of options, not only one options.
And I think you put it perfectly, Vino. I think that holding for longer option would probably be the last option that we have on the table, right?
Right.
And certainly not a bad option to have, as you can continue to collect the cash flow as the property is appreciating, and when the timing is right, you can certainly exit and kind of ride off into the sunset. So very well put and well said over there. And let me see if there's any other questions. So if there are no further questions at this moment, I would certainly want to take the time and thank you all for joining us on this Thursday evening. Our sincerest hope is this was valuable to you, and certainly in times like these, we want to, make sure we're able to provide as much clarity and transparency as we can as to what we're doing in the marketplace and what the trends are, and certainly share our experiences and what we have seen in the past, and even currently what's happening now with the assets that we have. So I want to thank you all for joining us. Vino, do you have any, last remarks as we head off?
Let us know if you, need anything else from further, you can email, text, call us, we got one more, question, which told me that advantage of K1 takes the advantage when you sell the property.
So I think if I understand correctly, this probably question is relating to the depreciation, right?
Yes.
You want to touch upon how we give the
depreciation? Usually we handle that. Usually we handle those kind of situations. We get in a bigger property and get you a bigger depreciation on the next property. So in this case, let's say it was only 35%, 40%, you already use your depreciation. Now you have a capital gain. We get in the bigger property where you have a bigger capital gain that offsets your, capital gain.
And I think you get a K1 at the end of the year. That K1 would highlight that loss. If you're an active investor, you can certainly offset your active income. If you're a passive investor, you can carry that forward. And as you're exiting the project, you can certainly help it offset your gains and what have you. The least it will do for you as a passive investor is you're gonna be able to offset the gains that you're getting as the passive income throughout the holding period, right? And certainly any other questions we can on that topic we can clarify. I think there's a follow-up question to that, Vino. If you make more than 150, it's no good for you. Is it right? Are you aware of that? If you're making more than 150K, is there a, I guess?
No, I don't think that's true. I don't know where that CPA is coming from, but, we can get on touch offline. I think we, tried a couple of times, but we really need to answer all your questions. So you can reach out to us and we can, answer those questions.
Perfect.
Because I think what they're looking at is between the active investor and passive investor.
Passive.
And you can be active investor as long as you're spending 750 hours per year doing your real estate management, or taking care of your asset that you're investing in there. And so this educating the CPA, I think that's the key.
Perfect. All right, so I'll take the moment. Gentlemen, Viraj, Karan, thank you. Vino, thank you. And
Thank you, everybody.
have a great evening. We'll sign off
Thanks
now.
everyone for joining.